What are Robinhood stocks? The stock market is notoriously difficult to predict. Even experts struggle from time to time. Whether you trade directly on the markets or through a spread betting platform, it's important that you know how to analyze the information in front of you. One method of doing this is to employ moving averages. Moving averages are a lagging indicator. This means that they tell you where the market has been and you have to interpret how to take them forwards. The first element of the moving average is to create the average first, so you would take the previous X number of prices and average all these prices out. To get a moving average, you simply replace the oldest data with new data as it comes along. So when you get a new price that you want to consider, you remove the oldest data from the calculation and include the newer data. This gives you a different figure. These figures are then used to create a graph much like the stock market in shape, but with certain fundamental differences, and it is these differences that inform your trades. If, for example, the current price is significantly higher than the moving average line but the two are converging, it shows that the market was overvalued but is coming back down to a reasonable price. The kind of average I've touched on so far is easy to work out. It is called a simple moving average because it assumes that every piece of data is equally relevant. Many experts argue that this is artificial, however, because with stock markets the most recent data is the most relevant and should be weighted accordingly. To that end, the exponential moving average was created. The EMA works out an average price but weighs the most recent data more heavily than the older data. This means that the EMA is very reactive to the prices of the market, and therefore many traders prefer to use it. Understanding the theory behind moving averages is one thing, trading with them is a little different. As mentioned above, one possible technique is to buy when the market prices move from level to above the moving average and to sell when it looks like passing below. Another technique is to use a combination of averages to work out the trends of the market. Most spread betting companies offer the ability to incorporate moving averages into your daily view of the market, and you can adjust the average depending on how much or little data you want to consider. Good trading on the market is a combination of staying abreast of news, good knowledge of both fundamental and technical analysis, and a fair amount of luck. So if you are new to spread betting, make sure you spend some time learning the tricks of the trade before you start risking your cash.